There is a number. A single number that changed everything. Not a stock price. Not a market index. Not the size of a deal. It's a number so ordinary that most people walk past it every day without blinking. But Warren Buffett, the man from Omaha, the oracle, the man who turned $40 of childhood savings into a fortune that would eventually surpass the GDP of entire nations, he saw something in that number that nobody else could see. Something that kept him awake at night. Not with worry. With hunger. Because he understood, even as a young man barely old enough to shave, that this number was not just a number. It was a machine. A quiet, invisible, unstoppable machine that printed money while you slept. What if I told you that the single greatest secret behind Warren Buffett's billions has almost nothing to do with picking the right stocks? What if the strategy Wall Street analysts obsess over, the complex derivatives, the hedge fund tactics, the billion-dollar acquisitions, what if most of that was actually a distraction? And what if the real engine, the beating heart of the greatest wealth-building story in modern history, was something so simple that a 10-year-old child could understand it? Something Buffett himself discovered before he was even a teenager, walking the streets of Omaha with a newspaper route, coins jingling in his pocket, his mind already racing decades ahead. The story I'm about to tell you is not the one they teach in business schools. It's not on the front page of Forbes. It's buried in the footnotes, hidden in the annual letters, whispered between the lines of interviews that most people never finish reading. Because the truth about how Warren Buffett actually built his empire is both simpler and more profound than anyone wants to admit. And once you hear it, once you really understand it, you will never look at money the same way again. Before we dive in, I want to ask you something. And I want you to actually answer it, down in the comments right now. If you found out today that one of your investments was silently sending you a check every single quarter, without you lifting a finger, would you feel richer? Or would you feel like it wasn't enough? Drop your answer below. I'm genuinely curious. And while you're down there, hit that subscribe button and leave a like. It takes 2 seconds and it helps more than you know. Now, let's go back to the beginning. It was 1941. The world was at war. Franklin Roosevelt was in the White House. And in a modest house on Dunlap Avenue in Omaha, Nebraska, an 11-year-old boy named Warren Edward Buffett was reading every book about the stock market he could find at the Omaha Public Library. He'd already read them all at least once. Some of them twice. He wasn't doing this for school. No teacher assigned it. He was doing it because the idea that money could make more money, without labor, without sweat, without his own 2 hands, lit something inside him that nothing else could touch. His father, Howard Buffett, was a stockbroker. The family wasn't rich, but they weren't poor. What they were was careful. And young Warren watched his father carefully. He watched the way the market moved. He watched the ticker tape with wide, quiet eyes. And then one day, sitting at his father's desk, he read something that stopped him cold. It was about dividends. The word itself sounds almost boring. Academic. Like something you'd find in a textbook between chapters on depreciation and amortization. But what Warren Buffett understood, what clicked inside his 11-year-old brain with the force of a thunderclap, was that a dividend was not just a payment. It was a vote of confidence. It was a company saying, out loud, to every single shareholder, "We made real money, and we're giving some of it back to you. Not someday. Now. Every single quarter." He made his first investment that year. Cities Service Preferred. 3 shares. He paid $38 per share. He saved that money himself, from his paper route, from selling chewing gum door to door, from a pinball machine business he'd started with a friend. And then he waited. The stock dropped. It dropped to $27 per share, and Warren felt something cold settle in his stomach. Every morning he checked the price. Every morning it was lower. He could feel his friends' stares, or at least he imagined he could. He had told his sister Doris to buy in too. And now he was watching her money shrink. The pressure was immense for a child. Crushing. He could have sold. He almost did. But he held on, and eventually, the stock climbed back up. He sold at $40 a share. A small profit. A relief. And then he watched it go to $200. That moment burned into him. Not with regret, exactly. With something sharper. A lesson written in fire. He had sold too soon. He had let fear make his decision. And worse, he had ignored the dividends the company had been quietly paying out the whole time, the small checks arriving like clockwork, the mechanism already working, already humming, while he'd been staring at the price. He would never make that mistake again. Here is where most people get the story wrong. They hear Warren Buffett and they think about the acquisitions. They think about Coca-Cola. They think about Apple. They think about the headlines, the shareholder meetings in Omaha that feel more like rock concerts, the famous quotes on Twitter. But the architecture underneath all of that, the skeleton, the foundation, the invisible scaffolding, is dividends. Specifically, it's the compounding power of dividends reinvested. And this is where the real story gets almost terrifying in its implications. Imagine you drop a single snowflake at the top of a mountain. That snowflake rolls. And as it rolls, it picks up more snow. And the more snow it picks up, the faster it rolls. And the faster it rolls, the more snow it picks up. This is not a metaphor. This is the literal mathematical reality of dividend reinvestment. Every check you receive, instead of spending it, you buy more shares. Those shares generate more dividends. Those dividends buy more shares. The machine feeds itself. It accelerates. It becomes something that cannot be stopped, cannot be slowed, and over long enough periods of time, decades, not months, it becomes almost supernatural in its power. Buffett understood this not just intellectually but viscerally, emotionally, in his bones. He used to describe money not in terms of its present value, but in terms of what it would become. A dollar wasn't a dollar to Warren Buffett. A dollar was $10 in 10 years. And a dividend, a steady, reliable, growing dividend, was fuel for that engine. It was the thing that kept the snowball rolling even when the market crashed, even when the economy seized up, even when everyone around him was selling in panic. And they did panic. Many times. The market crashed in 1974, and investment portfolios across America were bleeding. People were terrified. Financial commentators were using words like catastrophe. Buffett was buying. Not blindly. Not recklessly. But with the deliberate, almost predatory calm of a man who knew something everyone else had forgotten. He was looking for companies with strong dividend histories. Companies that had paid their shareholders through recessions, through wars, through oil shocks and inflation storms. Companies that had made a habit of sharing their profits because their profits were real. Because their business was durable. Because their competitive advantage, what Buffett called a moat, was wide enough that no competitor could easily cross it. That's the hidden layer of the dividend secret that almost nobody talks about. It's not just about the dividend itself. It's about what a strong dividend history reveals about the company underneath. A company that has paid and grown its dividend for 20, 30, 40 consecutive years is telling you something. It's telling you that its earnings are not imaginary. That its management is disciplined. That its business model works in good times and bad. The dividend is a signal. And Buffett learned to read that signal like a language. Take Coca-Cola. When Berkshire Hathaway began purchasing Coca-Cola stock in 1988, the position eventually grew to over $1 billion in cost basis. Today, the annual dividend income that Berkshire receives from Coca-Cola alone is hundreds of millions of dollars, every year, on that original investment. The yield on cost, the dividend income divided by what Buffett originally paid, is staggering. Some estimates put it above 50% annually. That means every 2 years, Buffett is effectively getting his entire original investment back, just from the dividends. The shares themselves are still there. Still growing. Still compounding. But here's the part that makes the whole thing almost hard to believe. Buffett didn't stop at receiving dividends. He used Berkshire Hathaway's structure to amplify the strategy to a degree that most individual investors can't fully replicate. The insurance float, the billions of dollars that policyholders pay into Berkshire's insurance operations and which sits available for investment until claims come due, gave Buffett access to essentially free money to invest. Money that wasn't his, but that he could put to work. And what did he put it to work in? Businesses and stocks with strong, growing dividends. The float generated investment income. The investment income bought more dividend-paying assets. The dividend-paying assets grew and paid more. The cycle spiraled upward, decade after decade, in a way that had almost no ceiling. And then there is the deepest layer of the secret. The one that takes the longest to see. Buffett didn't just buy dividend payers. He sought out companies where he believed the dividend would grow. Not stay flat. Not barely keep pace with inflation. Grow. Meaningfully. Reliably. Year after year. Because a growing dividend, compounded over decades, is not arithmetic. It is not linear. It is exponential. It is the snowball on the mountain, but on a mountain with no bottom. Washington Post. American Express. After the Salad Oil scandal, when the company looked like it might collapse and everyone else was running. Wells Fargo in the early 90s, when real estate losses terrified the market and the stock fell by half. Each time, Buffett looked through the panic to the dividend. He asked himself, will this company still be paying and growing its dividend in 10 years? In 20? If the answer was yes, the fear in the market wasn't a warning. It was an invitation. This is the moment. Right here. This is the part of the story that separates the people who read about Warren Buffett and nod politely from the people who actually internalize what he did. Because what he did requires something that most of us genuinely struggle with. It requires patience so deep it almost feels unnatural. It requires the ability to sit with an investment through a storm, to feel the market dropping, to read the headlines screaming catastrophe, and to not sell. To not panic. To hold, and collect the dividend, and reinvest it, and hold some more. For years. For decades. For the rest of your life, if necessary. Most people can't do it. Not because they lack intelligence. Not because they lack information. But because every instinct in the human brain screams at you to do something when things go wrong. To act. To sell. To protect yourself. Warren Buffett spent his entire adult life training himself to override that instinct. He used to say that the stock market is a device for transferring money from the impatient to the patient. And the dividend, the quiet, unassuming, underappreciated dividend, was the most powerful tool of patience ever invented. Because it gave him a return even when the price wasn't moving. It kept him connected to the investment. It kept the compounding machine running even through the longest, coldest winters. There is a human story underneath all the numbers. A boy from Omaha who felt the thrill of a stock climbing and the cold weight of it falling. A young man who watched his first profit slip away and turned the pain into wisdom. A businessman who built a culture inside Berkshire Hathaway around the idea that long-term thinking is not just a strategy, it's a moral stance. That patient capital, deployed in businesses that share their profits honestly and grow them reliably, is not just how you build wealth. It's how you build something that lasts. Something that means something. Charlie Munger, Buffett's partner for decades, once said that the big money is not in the buying and the selling, but in the waiting. The waiting. That one word contains an entire philosophy. It contains every lesson Buffett learned from that first investment in city service, from every book he read in that Omaha library, from every conversation with Benjamin Graham, his mentor, who showed him how to see value where others saw risk. The dividend is the reward for waiting. It is the market's way of paying you to be patient. And if you choose to take that payment and use it to buy more of the thing that is paying you, if you resist the urge to spend it, to cash it out, to celebrate with it, the machine accelerates. The snowball grows. The years compound on each other in ways that feel, after a long enough time, almost like magic. But it is not magic. It is not luck. It is not genius in the way most people imagine genius. It is discipline. It is consistency. It is the willingness to understand a simple idea, that a company paying and growing its dividend is a company that is earning real money and respects its shareholders, and to act on that idea for 30, 40, 50 years without deviation, without distraction, without the noise of the market pulling you off course. Warren Buffett is still in Omaha. Still in the same house he bought in 1958 for $31,000. Still eating the same breakfast from McDonald's. Still reading 500 pages a day. Still holding the same stocks he bought decades ago, watching the dividends arrive, reinvesting them, holding on. He has not cracked the code of the universe. He has done something harder. He has cracked the code of himself. He has mastered the patient art of letting money work, letting time work, letting the quiet machine of dividends run its course without interference. That, in the end, is the secret. Not glamorous. Not complicated. Not hidden in a formula or a model or an algorithm. It was there the whole time, in the simplest truth of all. Find great companies. Let them pay you. Let them grow. And never, ever be in a hurry.